Welcome to Al Stocks. In this video, I'm going to break down the earnings report for Clover Health and add some commentary in this one-on-one format. So let's get started. So the total revenue was $427.2 million, up 153% year over year. This was consistent of $204 million in Medicare Advantage premiums and $223 million in direct contracting revenue. Lives under the Clover management increased 125% year over year, with the GAAP Medicare Advantage MA medical care ratio MCR improved by 850 basis points. I'm going to go into what does MCR ratio even mean, because it's very important and it's the criteria that a lot of analysts are analyzing. So the MA PPO plan focused on underserved communities and it offered a wide provider network and it was awarded 3.5 stars. However, they concluded that they are striving for a potential move to a 4-point star, possibly in the year of 2022. Clover provides preliminary 2022 MA guidance, average MA lives of 82,000, up 20% plus year over year, and MA MCR in the range of 95 to 99%. So check this out. The ratio is calculated by dividing the total medical expenses paid by an insurer by the total insurance premiums it collected. So a lower ratio indicates higher profitability for the insurance company. So in short, MCR is equal to the cost over the premiums, right? How much they spend out of their pockets under how much they get. So the higher the bottom number, the lower the ratio, which is great, means the company is more profitable. However, the higher the top number, it basically means the company is less profitable. So there are some limits to how profitable an insurance company can become because of the Affordable Care Act. I believe it's at least 80 to 85% from when Obama passed it. That's pretty much how they calculate the MCRs. There's a lot of analysts that are overlooking this. Everyone's focused on the 150% year over year growth, and there's something so important in this data, and I'm going to tell you. So they had a primary care physician, right, who had 2 lives, one under the management of the Clover Assistant platform and the one without. And they found that the one under the Clover Assistant platform, MCR ratio, that was 1,000 basis points under from the patient that did not have Clover Assistant. What that basically tells you is that the Clover Assistant platform saves money, which obviously has been what they've been saying since the SPAC went public under the Chamath IPO. So they go further into this and they talk about their MCR ratio. And they found that the longer you have Clover Assistant, the more money you're going to save. They looked at 2018 PCPs and 2019 PCPs and 2020 PCPs. And they found that 2018 PCPs had a better MCR. The ones that adopted Clover Health early had a better MCR than 2019 PCPs. And the 2019 PCPs who started going live with Clover Assistant had a better MCR than 2020. And then the doctors that used Clover Health in 2020 had a better MCR than 2021. This seems like it is a platform that learns and continues to evolve, aka the whole artificial intelligent disruptive tech that they're basically communicating to the general population. In fact, Andrew Toy, the president and CTO of Clover Health, he talked about how they report Clover Assistant as its own little entity, its own little company. And I believe that this company, he said, could be branched out to different sectors that want to provide the Clover Assistant platform. Think of it like Palantir with their Foundry software, how they're able to essentially license their Foundry software to different organizations. I think that's what Clover Assistant is going to become, hence the fintech meeting that they just recently had. So the CFO continued stating that Clover Health continues to scale with a current annual revenue run rate of $1.7 billion. So lives under the Clover management at quarter end was approximately 129,100, an increase of 125% compared to September 30th of 2020. Medicare Advantage memberships and direct contracting lives were 67,281 and 61,818 respectively as of September 30, 2021. But this is very important. If you look at their GAAP Medicare Advantage MCR for the quarter, it was 102.5%. That's for literally Q3 of 2021. If you look at it last year though, though, literally year over year, last year it was 86.7%. So that increase was obviously due with direct COVID costs. However, if you compare this quarter to last quarter was 111%. And we already stated that this quarter was 102.5%. This is for the MCR, which means that their losses are going down. They talk about how that's due to their operational efficiencies and also the downward trends that we've seen with COVID and the decrease in COVID costs. What makes me confused is the normalized Medicare Advantage MCR non-GAAP, which excludes the net effect of COVID-19. For Q3 of 2021, it was 94.8%. If you compare that to the second quarter, it was 96.3%, which is great. It decreased like around 2%. That's great. That shows me that they're getting better. But what gets me a little bit questioning the data here, if you look at Q3 of 2020, they said that the non-GAAP was 96.4%. So if you look at the gap of the original data that brings in the COVID-related expenses, Q3 2020 was 86.7%. But if you remove COVID expenses, Q3 of 2020 went up to 96.4%. I don't understand. If someone can help me on the comment sections understand why removing the COVID-related expenses increased the MCR, when in reality, I think that it would decrease it. That would be really highly beneficial for the group here. Then they went ahead and talked about their cash equivalents, and investments, which totaled $588.7 million as of September 30th of 2021. Lives under the Clover Assistant management grew 223% year over year. So what's interesting is they always report that Clover Assistant by itself. And I think that the future for Clover Assistant is going to be a separate software that they can sell as a license. We already talked about that. I don't want to bore you again mentioning it, but it is a big thing. My only question here is about the GAAP and non-GAAP. So just a reminder, the GAAP is including COVID costs and the non-GAAP is not including COVID costs. Which is confusing is that the COVID costs for Q3 of 2020 was 86.7%, but the non-GAAP, excluding COVID costs for Q3 for 2020 is 96.4%. So why the approximate 10% increase when you remove COVID costs? So that's something I want a little bit more detail on. And I'm going to go in and revisit the earnings report. Maybe I missed it. I just need to go in a little bit deeper on that. I find that kind of weird. If you look at the estimate analysis, everyone is hovering around $1.42 to $1.45 billion for the annualized revenue run rate. If we beat that, and let's say we hit 1.7, it's going to send a lot of fire alarms running through hedge funds and Wall Street that, hey, this company's starting to get on a lot of people's radar. And a lot of hedge funds are in battle with each other. So you got to understand that. If you look at 2022, it's funny because 2022 analysts say that it could go anywhere between $2 to $3 billion. And that's literally like $1 billion in their lower estimate versus their longer estimate. So long story short, I don't think this Q3 report's going to move the stock any up higher. This is a long-term play. I think the golden years for Clover Health is going to be at the end of Q4 and really the middle of Q2 of 2022. Right now, their goal is break even. I think by Q3 to Q4, they're going to be break even. And I think the start of Q1 of 2023, they're about to be break even. So I hope this was helpful. I'm going to be making a well thought out presentation, including all these numbers for the visual people, but I just wanted to get this out really quickly to you guys. Since you made it this far, if you like what you saw, consider subscribing, liking, and hitting the notification bell and all those things. And I would really highly appreciate that, as this takes some time to create and edit. So thank you so much.